Okay, so for debt investments, these are the flip sides of us taking out a loan from the bank, right? So typically what we're going to talk about in this section is bonds. We're going to be purchasing bonds in other companies. So we are going to be borrowing, or excuse me, we're going to be lending money to another company essentially. So bonds are just another way for companies to generate capital. But instead of borrowing from a single lender like a bank, they're going to borrow from probably thousands of different lenders who purchase their bonds. They're selling their debt. It is a promise to repay them plus interest at some point. Okay. There are four events that you need to know about when we have a debt investment in another company, like bonds. They are the purchasing of the debt security, when we receive the interest, and then the holding the investment during periods in which the investment's fair value changes. That's your unrealized holding gains or losses. And then you're either going to sell the investment before maturity, realized gains and losses, or you're going to receive the principal payment at maturity. Okay, so just know what we're actually going to talk about in this class is we're going to walk through events 1 and 2, purchasing and receiving interest. We're going to skip step 3. We're not going to talk about fair value changes and adjustments to bonds. It's a little trickier, and bonds are a lot more stable than equity purchases, right? We know that the stock market's extremely volatile. Bonds, typically not so much. Okay. And we're also only going to talk about holding the bonds to maturity. We're not going to talk about selling them before the investment matures. Okay. So let's record the purchase of a debt security. So let's say that on January 1st, 2024, Nathan Sportswear purchases $100,000 of 7% 10-year bonds for $100,000 with interest receivable paid semi-annually on June 30th and December 31st of each year. The bonds are issued at par. Par basically just means they're selling the bonds for what they say they are worth. Okay. Now, please note, semi-annually is important for us to pay attention to. It doesn't change the interest rate. The interest rate is still 7% because interest rates are given as annual rates. Okay, but you do need to know, you need to pay special attention to terms like semi-annually, quarterly. Okay. What semi-annually means is that the interest will be paid twice per year. So all we're doing in this entry, this transaction, we're just recording purchasing the investment, purchasing the bonds. So we're going to call it investments, or we're going to call it investments in bonds, whatever the case is. And you're going to record it for $100,000. That's how much we bought. And we used cash to buy it, so we're going to reduce it by $100,000. Again, a net zero impact on our accounting equation. Now, what we're expecting to receive in the form of revenue is not dividends, but it's interest, right? They borrowed money from us. What's the cost of borrowing money? Interest. So our expectation is that they are paying us interest every year, okay? So let's calculate the interest. We're going to use the amount times rate times time, that ART formula. So what's our amount? $100,000. What's our interest rate? It's 7%. That would give us $7,000. Then you multiply that times 6 over 12, and you get $3,500. That is for the first interest payment at the end of June. Okay. So here we can see we're going to increase our interest revenue, which increases your net income, which increases retained earnings. We have an increase in assets, the cash of $3,500, an increase in retained earnings of $3,500. Your balance sheet, your accounting equation balances, and your debits equal your credits. So we are happy and good to go. Okay. Now remember, you're going to do this again at the end of December. You're going to get another $3,500. Now let's say we hold this bond to maturity. What that means is at the end of 10 years, they're going to pay us the $100,000 back that they owe us. Okay. That was the deal. They borrowed money from us for 10 years, $100,000 to be exact, at 10%, or excuse me, at 7% per year. We've already been calculating that interest revenue, so there's no need to do it now. Now is the date of maturity. All that's going to happen is we're basically reversing out that initial journal entry. Okay, so we get $100,000 in cash, and we have taken an investment off of our books. Okay, again, net zero impact. Now, let's talk really quickly here about cash and investment analysis. The first one we're going to talk about is the cash holding ratio. Okay, so cash companies are going to hold on to cash for a bunch of different reasons, right? And there's differing reasons why one company holds more than another. So companies that are growth industry are typically going to hold on to more cash. They're going to have a higher cash holding ratio simply because they are taking that cash and they are reinvesting it into operations, right? changing technology, the volatility of operations, foreign operations, dividend policy, all of these are different, right? So if your policy on dividends is that you pay cash dividends every quarter, you need to have the cash. You need to be liquid enough that you can actually pay those every quarter, right? Foreign operations are scary because of foreign currency translations. Volatility of operations, those are scary because, like we said, if you operate in the stock market, if you are a hedge fund, the volatility there is excessive, right? So you want to hold on to a little more cash, okay? So since we're using a ratio, we can compare company to company. That's always the nice thing about using a ratio instead of just a straight dollar amount. The one good thing, one thing that you can have that is a benefit of holding on to cash is you have that safety net, right? You've got this safety net that if something happens, if one of those contingencies comes up, then you've got the cash to cover it. But what happens is you're foregoing the opportunity to earn revenue from that cash, okay? And the decrease in revenue is a decrease in net income, which decreases the dividends that you're going to pay out more than likely. And that makes your investors unhappy on occasion. So the cash holdings ratio, very simple. It's your cash and cash equivalents divided by total assets. Notice both balance sheet accounts, no need to use averages, okay? So here we've got an example of Microsoft. They have $8.759 million in cash and cash equivalents and $258,848 million of total assets. Their ratio can be calculated like such, okay? What that means is 3.4% of all of their assets is cash or cash equivalents that is sitting there, right? It is available to them. They could pull it out immediately, okay? We also have the investment to assets ratio. This just tells us as a total percentage of our assets, how much is invested. So we take our short-term investments plus any long-term investments. You divide that by your total assets. That's going to give you your investment to assets ratio. What this says is, you could think of it as saying that for every dollar in assets that Microsoft has, 47.8% or 47.8 cents of that is invested somewhere else, either in equity or debt. Okay. Then we have the return to investments ratio. This one, I know it looks a little funky on the slide. Those are not minus signs. Those are dashes, hyphens. Okay, so this is going to tell you when I make an investment, how much gets returned to me. Okay, so you take your investment related income or loss, and you divide that by the average of your short-term investments and the average of your long-term investments. That will give you your return to investments ratio. So in this instance, we see it's 3.5%. Essentially what this says is that for every dollar that Microsoft is investing, 3.5% of that gets returned as investment-related income. Okay, so 3.5 cents for every dollar is returned as investment-related income. That is cash, debt, and equity. If you have any questions, please feel free to contact me.